All right, everybody, welcome back to another episode of the Evernest Real Estate Investor Podcast. I am one of your hosts, Spencer Sutton, and I got with me Gray Hall. Gray, welcome back to the show.
Thank you. I'm excited to be here. Two amigos, less one amigo.
Less one amigo. You got to, like, I'm looking at you. If you're looking at this on YouTube, it's a different angle for you. Like, this is not your normal angle. You typically were looking like you're looking up at us.
I know. I went from MacBook looking up at me, and I had another camera. So trying to improve the video quality. That's got this fancy little light right here too. So we're trying to step up our game.
Man, you're looking good. I'm actually in a new office, so we finally got out of we're not working from home anymore. At least some of us aren't, and we're in a new office here in Birmingham. So good to do this with different vantage points. So today we really just wanted to do a pretty quick a market update. So we're halfway through, almost halfway through 2022. We've had a very, very strong run the past 2.5 years. Gray, you're in the brokerage side of our business. So you're seeing a lot of what investors around the country are buying. You're also talking with a lot of institutional investors. So I'd like to know, what I'd like to do is just kind of talk a little bit about what we're seeing in the market from pricing, interest rates, demand, all of that. So where do you want to start with this?
Yeah. And it's interesting. I mean, the things have kind of rapidly changed. They were fairly consistent the past 2 years since we had COVID. Interest rates got dropped. There's a little bit of brief pause there, but it's, the housing market's really been on a tear from a home price appreciation and a rental growth standpoint. And if you've done any kind of bidding in the last 2 years, you know how competitive it has been. And that's really hard. I mean, what we've seen is, you had to be really tight on your diligence. A lot of times our conversion rates were a lot lower just because there was so much kind of capital flooding in the markets. Look, it makes sense in hindsight when you have 3% interest rates for investment properties. Of course, I mean, that's kind of naturally going to fuel stuff.
Right.
And so, it's kind of interesting. We, even beginning of this year, looking back at some podcasts up until about March, the rates kind of remained consistent, and we've had a big shift and a very quick shift. So, I mean, historically, when there's inflationary environments, they're going to tighten up the rates, and it's a lot slower that the Fed will kind of raise those, but the rates really quickly jumped into the fives. And so a lot of investors are asking, hey, what does that mean? Is this a good time to buy? Should I be fearful to buy? What is kind of the outlook? So, we don't have a crystal ball, but we're going to try to kind of synthesize some of the information with other groups that we've talked to, and people like John Burns, who puts us to good information. But things have rapidly changed. And so kind of, the biggest thing is interest rates. So like, what does that mean when prices remain the same and your borrowing costs go up?
Yeah, because
your yield goes down.
That's right. Because we haven't seen prices like dramatically drop for houses yet. Like they're still pretty steady. Now they may not be rising as much as they did in the past, but they're still up there pretty high. And then your interest rates rise, so your yield falls. So what does that mean?
Yeah, I mean, the same property 2 months ago with a 3%, 3.5% interest rate versus 5.5, you're just paying more in interest. And the thesis is, well, that should make home prices come down. So if you look at the homeowner, they can afford less. So before they might have been able to afford a $500,000 house, now they can only afford a $400,000 house. So what does that do? That takes less demand of that $500,000 house, and you might have a lower bidding pool. The other interesting factor, though, is this whole supply demand. So there's ranges anywhere from we're 1.5 million units short to 5 million units short. And so the two kind of factors at play is the supply of kind of single family homes, both for homeowners and investors, is that low enough where that's going to continue to push up prices? So even though you might not get, a good example is like you might have gotten 30 bids on a house. Are we just going to start seeing 3 bids, 3 offers? Is that kind of the new normal? So still competitive historically. The reality is like inventory has started to rise the past 2 months, but we're still at, less than a month of supply, meaning if we stopped adding new houses, we'd sell out all of the homes within, a month of being on the market. And so there's probably some headlines saying, hey, inventory's, continuing to rise, but you really need to zoom out and have context. And so those are kind of two of the factors I'm quickly watching is just, what is interest rates going to do on the demand for investors and homeowners, and how does supply play into it?
So what are you seeing investors do right now? So people that we are talking to that are, they've got cash, they've got the ability to buy, like what are people doing now? Here we are, middle of June, 2022. What are you seeing in the market?
Seeing people probably be more selective. Probably be more selective. I think it has pushed some buyers out. I think there's a cohort of buyers that are going to say, hey, we're going to see what happens. And there's a cohort that says, hey, for the right deal, we're still going to buy. And then you still have institutional capital coming in the space. You know, they may have raised a fund. But I think more so we're just kind of in this interesting period where people are saying, hey, where's this going to go? I think on the opportunistic side, I've had some interesting conversations where some people have a thesis that, hey, a lot of people are going to pause and maybe kind of adjust and see where interest rates go. Are they going to continue to bump up? Because we do have projected rate increases. I mean, interest rates are probably going to be as low as they are today throughout the end of the year. So that's kind of a vote in favor of, hey, continue to look for the right deal. Rents are probably going to continue to grow. I mean, all the data that I'm looking at says rents are going to continue to grow, especially in like recessionary environments. I looked back since 1985. Rents have had positive growth every single year, no matter if it's a recession or if it's a bull market. And then home price appreciation. So that kind of dynamic that we talked about, people are fearful because I think we've got this recency bias where the last recession was a crash that was housing related driven. We've got very different fundamentals now with much lower supply. The lending criteria is a lot tighter. And so I hear this term a soft landing a lot. So kind of the most experienced people, way more experienced than us that look a lot more data, are thinking, hey, it's kind of a return to normalcy. We still have a long way to go. Like inventory still needs to triple to be like a very balanced market. So that's kind of like a comforting thing as I'm talking to investors of like, I don't see a crash coming. I don't have a crystal ball. I mean, none of us do. Right. It would kind of have to be a black swan of that. But all of those kind of factors point towards, hey, a little bit return to normal. I think it's the opportunity is, hey, it's less competitive. Then you can still get deals in that. So I think you're going to have a better conversion rate kind of in this market, even though you've got higher debt costs. But at the end of the day, if you can project in what the rents are and, project in some rent growth in there, I still think deals can make sense.
Yeah. Yeah. I looked at the same data that was talking about like even through 2008, 2009, 2010, like rents increased. Like we've always had rent increase. And I would say even now, like, of course, we're in a lot of different markets. The demand for rentals is off the charts, like, and it's going to continue to grow. So I think that really bodes well. I like what you're saying, because for an investor, if you're out there and you're diligent and you're looking, you will find deals, especially as sellers maybe start getting a little bit nervous. So it's not just buyers getting nervous. Some sellers are getting nervous, go, oh, well, maybe I need to discount this house, or, I don't have tons of people asking me to buy my house at a deep, discount or whatever, buy my house now. So I might need to cut the price. So I think that's also good for investors if they continue to look for deals.
Yeah. And I think going back, I mean, I think there's kind of a lot of ways to look at this. If you're in a position where you've got cash reserves and you're underwriting deals that are going to cash flow with current interest rates, and you're getting quotes on that, whether it's in the 5s or the 6s, homes are sitting on the market longer. Days on market are creeping up in a lot of the markets that I'm tracking. And there's opportunities to get properties below list now, just because there might not be as much competition. And so if you can still be aggressive while protecting your downside, you can still get deals. And especially for the long-term like outlook on this, I mean, buying 1 to 2 deals this year, next year, the year after, kind of dollar cost averaging and getting this market exposure over the long haul. Because the reality is, even John Burns was talking about on this podcast I listened to, he was like, hey, his recommendation would have been to stop buying a year ago. And he was like, I was very wrong, because the market continues. So I think timing the market is very hard. So that's not what we're trying to do. We're trying to just kind of analyze, hey, what are all the factors? And look, this is not unlike last year where we were analyzing the same factors, and the year before that, and the year before that, every time since kind of, the recession. And so it's just, it's an interesting market. I think those are kind of the factors that like make me still bullish on this market. Is we're probably not going to see the 20% home price appreciation that we have seen. I think that was probably a unicorn year fueled by low debt. But I still think a lot of the fundamentals are still in the market. Still there. And so, it's interesting to hear these guys kind of talk about this kind of macroeconomic and then zoom in and see what we're seeing on the ground.
Yeah. So this is, really good. I think, what would you encourage? What's your advice to investors? Maybe we have some first time investors. They're like, hey, now is the time. I've got some cash set aside. I really had been thinking about buying, but should I wait? Should they wait for a year, or should they, what are you advising people right now?
Yeah, it's a good question. I think it kind of comes down to, hey, what are their goals? What is their current financial status? And I think it's kind of a case by case. I mean, I think there's some buyers that say, hey, it's probably best to wait, but there's also buyers where it's like, hey, yeah, now is a good time. And it kind of seems more people are like, let's be methodical about this and really kind of target it in, opposed to buying whatever deal comes up just because there's kind of this frenzy. So I think it's like a good thing to like slow down a little bit and be more methodical. So I would still say it's a good opportunity, because we very well could be a scenario where, just like COVID, for those first 2 months, everybody kind of slowed down and freaked out, and then things really picked back up. Like, that's totally a possibility. On the other side too, like, house prices could continue to come down. At the end of the day, though, investors should be looking at cash flow and should have a long-term view. I would tell the person who's wanting to buy for 1 year and get 20% appreciation and then sell it, like, hey, that's probably not the best idea. Or, leveraging to the max where you don't have personal reserves, like, hey, probably you need to get some other stuff in shape before you do that. But somebody who's just kind of consistently buying and wants to buy 1, 2, 3 properties a year, that person should still buy and be excited. Hey, there's less competition on some of these houses. And if you believe in the fundamentals of a specific market, then that's a good time to buy.
Yeah, that's exactly what I was thinking. I think you had a really important point. Like, what are your goals? What are you trying to achieve? Is this long-term? So, and if it is long-term, then just being like, stick to the fundamentals, stick to your discipline, and know that if you're going to be buying properties over the next 10 years, then it's still a good time to buy houses, right? Mm-hmm. You can still buy it's still a good time. So yeah, again, for the short-term flipper, maybe they need to take a pause and take a break for a little bit. But for people who are looking out 10, 20, 30 years, I think it's still fantastic time.
I think the other interesting data point that I've looked at is, over the past 6 recessions, home prices have appreciated in 4 out of the 6. Mm. And that is also interesting because, again, recency bias. We had 2008, home prices decreased about 20% kind of nationally, some markets more so than others. But overall, the past 4 out of 6, they're not exactly tied. So I think there's going to be some movement. I think there's pretty consistent with talking about, hey, a soft landing, or things are softening up, or there's going to be kind of a slowdown. You've also got to take that in context of what we were just at, which was 10, 20, 30, 40% year over year appreciation. Right. And so it's kind of returning back to the fundamentals, where single family rental produces yield. Rents historically for the past 30 years have continued to grow, and 4 out of 6 recessions, home prices have continued to appreciate. So when you kind of package all that up along with the supply factor, all of those kind of point to, it's not going to be a crash, and there's still kind of long-term value in this. In the short term, we don't kind of know. I mean, over the long term, if those things, well, I would guess they'd probably continue to play out, and we'll look back similar to this time, whether it's a 6-month recession, a 12-month, or an 18. The stock market's not always correlated, which is why people sometimes like housing. So talking about diversifying out of the equities and kind of the bigger markets that are affected by different factors, housing is unrelated to those, or they're not completely correlated. I mean, I think the broader economic markets kind of affect those, but they're not always directly correlated, where when the stock market comes down, then the housing is going to as well.
Yeah, this is good. I mean, this absolutely feels a lot different than 2007, 2008. And so back then, I just remember there being some irrational confidence in like our ability just to weather anything. And it was like nothing was going to really change on our end. But but that kind of unraveled over the course of a year or two. So I was watching this John Burns thing, and he said prices peaked in 2005. And then, then things started kind of to slow down 2006, and then subprime in 2007, 2008. So yeah, I think on
that point, the low point of the stock market was sometime in 2009. Yeah. The low point in housing was 2012. So you just said peak to trough, 2005 to 2012 was 7 years. I think that's another thing I've been reading a lot about, is housing is just very slow moving, because you can't panic sell a house. You can't just, hey, all of a sudden I get fearful. Like you
can't push a button.
Trade
Yeah.
those.
Right.
Yeah. Look, if Zillow had kept buying, maybe you could have, but we're not quite there yet. So I think that's another factor is like people are anticipating, like housing just moves really slow. So if there is a softening, I mean, it's going to probably take 12 to 24 months. And so it's kind of hard to play with that too, as well. I think that's like another thing why there's so much kind of strategizing and looking at data and trying to get as good as possible. And a lot of the stuff we're talking about is macro. I think investors who know a local market probably have a competitive advantage.
Yeah.
And I think it's also a time where, hey, buy the best house that you can. I think what we've seen the past couple of years is you could really sell anything. I mean, houses on busy streets, houses with a bad layout, kind of the white elephant ones that we've talked about other. And I would say if we are going into where, there's any kind of softening and you want to have that exit strategy of being able to sell, picking the best house in the best location that has kind of the most updates or doing some updates to add value to it is probably a strategy to look at, opposed to, hey, just buying anything you can get your hands on for yield because it's if the market was changing, that would be kind of another thing that I would be thinking about is, picking the best house. And that could be within a C class, an A class, or a B class neighborhood. So I'm not saying to necessarily change classes, but be pickier potentially with the houses you want, because the good houses are going to rent quickly no matter what market you're in. And that's what you want at the end of the day is decrease vacancy.
Yeah, I agree with that. I mean, I was just talking to somebody the other day and they were asking about the first houses I bought. It was a 10 package portfolio and they were just like, some of them were like completely trash and they were horrible. I said, but it didn't matter. This was 2004 or 2005. I could sell whatever I wanted to. Like I picked out the dogs and just sold them off and it didn't matter. And we've been in that type of environment now where you could literally buy anything and sell it or rent it really quickly. But to your point, don't do that. Be pickier. I like that advice. Just make sure you're buying the right house that you know is going to rent in whatever kind of market. So, yeah. All right, great. This has been good. I mean, this is a short one, but we just wanted to kind of give a quick market update of the things that we're seeing out there. Gray's on the front line. A lot of his agents are on the front line. They are still buying properties for investors all over in all of our markets. So if you're interested in reaching out and talking with one of our agents, just go to our website, evernest.co/ is it real estate partner?
Yep.
That's it. Evernest.co/ real estate partner. You can find out more information about what we do for investors. And but we'll be back next week. I think we're going to have a special guest on next week. We're going to actually talk about the Kansas City market and talk about some deals that we're seeing up there. So stay tuned. We'll be back in 1 week with another episode of the Evernest Real Estate Investor Podcast.